I'm very excited to be talking to Christine Benz, who is the Director of Personal Finance for Morningstar and a senior columnist at Morningstar.com. She wrote a cool-sounding book called 30-Minute Money Solutions, a step-by-step guide to managing your finances. Christine, we don't actually have 30 minutes, but in about the next 10, 12 minutes, let's see if we can cover a couple of things. And I think the first thing that a lot of people certainly ask me in my day job as a financial advisor is they go, oh, well, Morningstar likes that fund. They must know what they're talking about. They gave it 5 stars. Let's just buy only 5-star Morningstar funds. What do you say to someone like that?
Well, first of all, I say we're not the veggie burger people because I sometimes hear that, oh, Morningstar, you guys are the veggie burger people. So not the veggie burger people. But there is a lot of confusion about this star rating that we have for mutual funds. The basic idea with the star rating is that it's designed to give you a quick snapshot of how a fund has balanced risk and reward relative to other funds that invest in the same way. It is not meant to be forward-looking. It's not meant to point you in the direction of the funds that will necessarily perform best in the future, because one thing that we know from evaluating investments and looking at funds, and you've probably seen this if you've seen ads on TV for mutual funds, past performance truly isn't very predictive of future returns. So you might look at it and say, well, this is kind of how a fund has done in the past, but don't use it as a gauge of a fund's worthiness going forward. You really need to do a little more homework than that.
But let's say that you have decided to buy a fund in a certain sector, for example, and you're going to decide between, the 10 funds that do it, and some of them are 5-star funds and some of them are 2-star funds. You guys, it seems like, have already done the work. Wouldn't it just make sense to buy the 5-star funds? And I know, and I get your disclaimer that certainly it's not predictive, but comparing one fund to the other, isn't that kind of the point of the stars?
It's maybe a starting point for your research process. One thing to know, though, is that sometimes the funds that have had very strong returns in the past are also doing something a little riskier than their peers. Not always, but it's sometimes the case. So maybe they are investing a little bit more narrowly and focusing their bets a little more narrowly on fewer stocks. Or maybe they are packed into one little industry within that broader sector. So you need to understand what sort of risks the fund has taken to generate returns that are better than its peers. So take a look at that. And I do think that you need to look at the fundamentals of the fund as well. So one data point, while past performance isn't particularly predictive according to all of our review of the data, one data point that is in fact quite predictive is simply the expense ratio that you pay for that mutual fund. And I would reckon that this translates across borders no matter where you're investing in the world, that if you can reduce your investment costs, you have a better shot of having a better experience, of finding your way to a better product. So we do
that makes a lot of sense.
Yeah, we find expenses are really, really predictive. And it's counterintuitive because we all live in a world where you get what you pay for, right? If you spend more on a car, it's probably going to be a better car than if you really cheap out. But
I love my car, which was pretty cheap. Let me just touch on something you just said a minute ago, because I just want to clarify. Again, and really I want to move on to questions about planning for retirement,
Sure.
But I'd like to understand something about the way Morningstar does the research. Don't you build into the qualifications into the study and the star rating of a fund, don't you build in the risk ratio? So if there was a mutual fund that only had 2 stocks inside, but did really well, it would not get a 5-star rating because it has such a high risk?
Yeah, that's a very good point and very true that the star rating does encompass risk. The problem is that a fund may have risks embedded in its portfolio that haven't shown themselves yet. So maybe a fund is taking some risky bets. They've paid off tremendously well, but they may come home to roost at some later date. Mm-hmm. And so that's why I'm saying it pays to kind of look at that portfolio, even though risks may have not whacked a fund in the past, they may come up and hurt it in the future. So take stock of what risks might lie within the portfolio.
Is there a tendency with the ratings, I'm presuming you've studied something like this, to have kind of a reversion to the mean? So if there's a fund that maybe was a 5-star fund, for a couple of years, it's likely to be a 1 or 2-star fund following that, so that eventually they all kind of average out?
Yeah, we do try to keep track of this, and oftentimes we do see exactly that pattern where the fund may be riding high for a few years or even maybe a decade or longer. and then suddenly hit that market environment that is just not favorable for its style. Doesn't mean that it's a poor fund, but it does mean that even the best performers, even the best fund managers periodically mean revert. And so we see their performance drop back to average or even below average for various periods of time. So that's one reason we always encourage investors to make sure that they have a nice long time horizon for whatever investment that they're looking at. And also, if they are using some sort of a managed product, understand that even really good managers have these periods where they look terribly out of step with the market and may underperform their peers.
We're talking with Christine Benz from Morningstar. She's been talking to us about what the Morningstar structure is. So many people rely on the star rating. And one of the things I think that Christine is pointing out is that we shouldn't necessarily rely on that. It's one data point that people can use in making a decision about buying a fund, but it's certainly not the only one. Christine, a lot of people, when they're planning for long-term growth, they have the ongoing argument, which is, even if I buy 5-star funds, the mutual fund industry and money managers don't always, not only do they not always beat the index, but they frequently, and the majority of times, they don't even beat the index. Why would someone spend so much time doing the research on the mutual fund industry if these funds aren't even beating the index? And should investors even look at mutual funds these days?
Well, one interesting trend that we've been monitoring has been a tremendous outflow from actively managed products. So mutual funds where there's an active stock picker at the helm, and maybe he or she is flanked by a bunch of analysts who are doing qualitative bottom-up research on companies or on bonds. One thing we've seen is this tremendous outflow from these actively managed products toward products that simply track a given market benchmark. So investors seem to be voting with their feet and saying, when I look at, and we certainly say this, when we look at the performance of the typical active fund, what we see is that the average active fund does not beat its index over time. I don't think that rules out the possibility that an investor can select a good active fund that will outperform over long periods of time, but certainly investors are looking at the data. They're quite compelled by the low costs of index products as well as exchange traded funds. So we see investors very much making that swap away from active stock pickers. A little bit less so on the bond side. We still see many investors casting their lots with active bond funds, but certainly on the equity side, dramatic outflow from active products.
Let's just talk for a second so that people understand the difference when you talk about an index fund and then you differentiate it between an exchange traded fund. What do you mean as the difference between the two?
The key difference is an index fund is like a traditional mutual fund in that the prices of the securities are totaled up just once a day. So there is one price for that mutual fund per day. You can't trade it intraday. So if you wanted to get out of a fund at 2 p.m., well, you'd have to wait until the end of the day, until all the prices of the portfolio were totaled up to be able to determine at what price you would be selling. And an ETF or exchange traded fund allows for that intraday trading. The prices are calculated throughout the day. And so it gives active traders a little bit more flexibility. Both types of products have very low costs on their side. So I typically say for investors, for long-term investors, which should be most individual investors in my view, an index mutual fund is going to do the job just as well as an ETF, in part because individual investors shouldn't value that ability to trade intraday. That probably would mean that they are trading a little bit too much than might be good for their health or wealth.
Yeah, I think people also have to realize that an ETF is a very broad term, and it stands for exchange traded fund. And although many ETFs simply track an index, meaning inside that basket, it might just be the S&P 500 or the Dow Jones Industrial Average or any of hundreds or thousands of other indices, it doesn't have to do that. An exchange-traded fund actually could have some strategy inside, and there could be a management system inside that's not just following an index. So you really need to look at what you're buying and don't just say, oh, I buy ETFs because, I'm an index investor. That's not necessarily a true statement.
Absolutely. In fact, there's been an explosion of interest in the other type of index funds that you referenced that track specific factors, for example. So maybe they are looking to capitalize on the value effect or the momentum effect. So index funds can be created quite differently, ETFs as well, and they're not all market capitalization weighted index trackers.
Yeah, so I guess the moral here is to look really closely at what you're getting,
Exactly.
look at the fees that you're paying, and as we said, don't just rely on one factor. Christine, I'm relying on you for a very, very good explanation of how the fund market works and the ETF market works, and I simply didn't have time to get to some of the very important things that I know you have a lot to add about planning for long-term investing, but maybe we'll have you back sometime soon. In the last few seconds, could you just tell people how can they follow you and follow your work?
Sure. My work is primarily on Morningstar.com, www.morningstar.com. And I write a few columns a week. I do a lot of videos for the website and focus specifically on the intersection between retirement portfolio planning and investment planning.
All right, Christine Benz, thanks so much for taking the time. Looking forward to having you back soon.
Thank you, Doug. I enjoyed it.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.